All right, in today's episode, we're going to geek out on market stats to try to make sense of this crazy real estate market. Let's go! Hey everybody, how's it going? Russell Westcott here. So hope you're having yourself a wonderful day, and thank you for jumping into this upcoming video. In this upcoming video, you're about to have a detailed analysis on what's going on in this crazy real estate market that we're in right now. Although myself and my guests go very detailed into a lot of national numbers, remember, real estate is regional, even hyper-local when doing your analysis. My guest today is research analyst Ben Rabidoux, and Ben and I go very deep into market analysis of what's going on in the real estate market. So if you're interested in trying to make sense of what's going on with the real estate market, we talk on some big, deep topics. We talk about inflation, we talk about interest rates, we talk about supply demand, and we talk in depth about a market call of where the market is headed. Plus, we take a deep dive analysis into what's going on in the Alberta marketplace. So if you're interested in finding out what's going on in this real estate marketplace, you will thoroughly love this episode. All right, please help me welcome Mr. Ben Rabidoux. Ben Rabidoux, how are you today, my friend? How are things out in Eastern Canada?
It's good, Russell. It's a pleasure to be here.
Well, I'm seeing that we got the same barber here. You know, Gillette Mach 3 is really good.
That's right. Yeah, you're looking very stylish.
Yes. Are you a clippers guy, or are you a blade guy, or how do you do your hairstyle?
Oh, I am clippers. Yeah, kind of the little half moon shaped clippers are the best. Yep. I find. Yeah. Well,
I'll tell you, you want an insider secret? I found this head shaver this past year called the Pit Bull. Makes me feel a little more manly. Is you can actually use it in the shower. You put it in your hand and you just shave your head while you're in the shower. We're doing all your good thinking and thinking about all your research.
Oh, there you go. Okay. Well, thanks for that tip.
See, you come here for hair grooming tips, right? Ben, well, thank you for accepting this invitation. It was funny. We were just on Twitter a week ago, and you were making some wonderful tweets that you do. I highly encourage you to follow Ben on Twitter here. And we just had a little back and forth and said, why don't you just jump on the podcast and let's talk about some of the research you're doing. So first of all, thank you for jumping in here.
Well, it's my pleasure. Thanks for the invite.
Yeah. All right. Well, let's start at the beginning. So most of my audience probably doesn't know you that well yet, but you will get to know Ben very, very well here. I was listening to, Tom and Nick's podcast, Your Life, Your Terms, the Rockstar podcast a little while ago. And I heard your name pop up, and I hadn't heard your name for about 10 years. It's been a while, and you were just dropping knowledge bomb after knowledge bomb. And I just, you know what, I need to reconnect with Ben because, about 15 years ago, when you first came out on the scene, you were a very big housing bear, if you will, when you first came out, weren't you?
I was. It's funny. There's definitely been, a shift in thinking, right? I mean, you have to be true to the data. And there was a time where I felt that the data was concerning in terms of what I was seeing build up in household leverage. And so I was quite vocal about that. And with the benefit of hindsight and a bit, time is the great equalizer and the great humbler, as it turns out. And you realize, you may not know what you think you know, and any good analyst is forced to reassess their worldview. And so what happened was it became fairly, bullish on housing, very bullish heading into 2019. So late 2018, heading into 2019. And really the cause of that was just this relentless decline in inventory that we were seeing across the country. And you just couldn't watch this relentless decline in resale inventory and not recognize that we were heading towards just like a blow-off top for housing. And so, it turned quite, reluctantly bullish at one point, and then eventually just kind of embraced it. And, here we are. And I do think most markets in Canada are going to squeeze quite a bit higher through the first half of the year. But I do think the back half of this year is going to be a little more challenging, and we can get to talk about that. But bearish Ben may at some point make an appearance if the data warrants it. But for now, I'm quite optimistic.
Holy moly! In 3 minutes and 41 seconds, you dropped a whole bunch of bombs already here for us, Ben. It was funny. It was, back at the time, and I was with the Real Estate Investment Network at that time, and it was almost like it was like either Garth Turner and Ben Rabidoux. You guys were the perennial bears. But one thing is, I 100% respect your position that you had at the time. It was 100% fact based. It was research driven, and at that time, it was probably what the tea leaves were telling you based upon the numbers, wasn't it?
Yeah, it was. I mean, I would say that I'm okay with any analyst. Look, when you're in the prediction business, you're going to get stuff wrong. I mean, that is the reality, and that's
what day of the week is it, right?
Right. And so, I don't begrudge anyone who is wrong on a call that they formed that was intellectually honest based on the data at the time and that was made in good faith. But you can't be perennially wrong and not reassess your view and cause yourself to question what you might have missed, right? And so, look, at some point the data will warrant a more cautious stance on housing. Housing, at the end of the day, is cyclical. We will see another cycle in our lifetimes, but as it stands right now, I've come to appreciate the magnitude of some of the undersupply that we've built into the market, especially single family in some of the big cities, which I did not fully appreciate at the time. And at the end of the day, we have not seen a true interest rate cycle. And as long as employment stays robust, as long as population growth stays where it is, and as long as rates don't really start to moon, then it's hard to get super bearish on housing. Yeah, at least not yet.
100% agree. And just talking about dovetailing that, there's an entire government agencies that start with a C and end with a C that had some pretty interesting calls over the last couple of years, and I'll leave it at that for interesting.
Okay, all right. Well, let's say this though. I think everybody gets a pass in the early days of COVID.
Yes,
because let's be honest, that was a crazy time. We're going to go our entire lives, and I don't think we're ever going to see another period of such economic turmoil. And to be staring at those economic charts and watching the magnitude of the job losses and just, unbelievable economic carnage, you couldn't look at that and at least, frame it in a slightly concerning light, right? Yeah. I think everybody at that point gets past. Nobody saw the magnitude of the government fiscal response. Nobody, right? And nobody saw how quickly the economy would rebound. So, if anybody did get that call right, kudos to them. They'd be like 1 in 1,000, right?
Yeah, exactly.
That's a tough one. CMHC was way off on that call. I was obviously, when COVID hit, you look at that and you go, holy cow, there's no way this ends well.
Yeah.
And it did. It ended up, but I've got a whole note out just kind of dissecting how that pandemic ended up being so positive for real estate. And it really is it's quite stunning.
100%. Now, I remember we had it's funny, it's with Tom Karadza, and I had a conversation, and we were sitting there going, you know what, we potentially could see the fear at the moment is deflation, and they're trying not to make sure deflation is going to be significantly worse than inflation. So let's make sure that the market doesn't deflate so we can't get it back. So the money and the stimulus and everything came, and then maybe the pendulum swung a little bit. Maybe the pendulum swung way too far to the other direction.
That's a good way to put it. I think you're absolutely right. The early days of the pandemic, the last thing you want in a highly levered economy like Canada is a deflationary spiral.
Yeah.
And so the risk is that you overcompensate to the other side. And I think we're seeing that. You're absolutely right. We're seeing inflationary pressures. Some of that's supply chain related, but man, we created a lot of new money supply in Canada. I wrote about that extensively. We've never seen the sort of monetary and fiscal stimulus that we saw really since the beginning of 2020, and it's just a remarkable time. So it's really difficult to have had strong conviction in the early days of COVID around anything, because it was just such a weird time.
Yeah, it's funny how when some people you say, we created an awful lot of money supply in the system, and a lot of people will sit there and go, well, I'm not seeing it. Where is all this money? Where did it all go? Right? So.
Yeah, no, absolutely. Well, a lot of it, you're right. A lot of it ended up going to, things like asset purchases by the central bank. So the Bank of Canada ended up buying hundreds of billions of dollars worth of government bonds. And so you don't see it because they bought it off the people who were selling it, right? And then they in turn turned around, took that money and bought financial assets. So you get stocks go way up and real estate goes way up. And that's where you see that money end up getting squeezed into.
Yeah. Well, I know we jumped right into the deep end and the deep waters here, Ben, but you mind if we take just a pause and a step back and, where part of Canada are you living in? And give us a little bit of your background. If you,
Sure.
It's like we meet each other and we just jump right in and share all the gold after that.
This is how
Tell us.
Two real estate aficionados are chatting.
We're just geeking out here, but tell us a little bit of your story. Where are you from? What led you down this path of being a real estate analyst? Are you an investor? Just give us some of the backstory.
Sure. So I'm in kind of central Ontario, a little north of Toronto, is where I'm based. I started in my early days. I had a public-facing website that you kind of referenced, got a lot of traction back in. I started that, I believe, in 2011, and by 2013 had enough of an institutional following. And of course, that website focused a lot on housing, macroeconomic trends, household credit. Had enough of an institutional following that was able to sort of parlay that into an institutional research product that is being consumed by wealth professionals in Canada and globally. And so those would typically be, mutual fund companies, pension funds, some hedge funds, sovereign wealth funds, those types of big pools of capital. And so that company today is Northcote Advisors, and that is still an institutional only product. And I am still active with that. And then more recently, I've started a separate service that's exclusively for real estate professionals, and that's called Edge Analytics. And so there I take some of the same concepts, maybe not quite as in-depth because it's not necessarily relevant to folks like yourself to understand how some of these, these data points might affect markets, but really what you want to know is how is that going to affect real estate and interest rates, et cetera. And so try to boil that down for you guys. We do 2 reports a month. And then also I think what's very valuable to my clients is we do marketing infographics. So we take some key concepts. I've got a great marketing infographics team that then churn out these really cool infographics, and people, subscribers, are allowed to take those. They can put their own branding on them. They can share them as their own. And it's just a way for them to kind of keep a touch point with their clients and their prospects and position themselves as sort of a thought leader in the industry. Yeah, there's one of them right there. Yeah, so they do a pretty good job of that sort of stuff. And so it's been well received. The idea ultimately is to create sort of a network through Edge Analytics from which, my dream is to be able to have enough subscribers that we can kind of start gathering intelligence from people across the country about what they're seeing in real time, right? What's happening with lead generation through their websites, foot traffic through open houses, and ultimately to try to create sort of a forward-looking index of real estate activity if we can gather. Because my view is real estate professionals are sitting on a ton of knowledge, and if we can, and really forward-looking knowledge about what's happening in real estate and credit, and if we can kind of harness that, then we can create some really cool data that can give us some predictive value, and ultimately that's of value for my institutional clients. So that's kind of the big picture with Edge Analytics. Yeah.
So you live, sleep, and breathe data and numbers, but more importantly, you're able to read what they say and make tangible action steps, if you will.
Yeah, that's right. And so you've seen kind of the research that I do. It's it's a lot of high level national, but then also try to drill down on some of the various regions, and then a lot of looking at the big picture trends, looking at key risks that are affecting the economy. Right now, obviously, we're spending a lot of time looking at inflation and interest rates. Prior to that, as you're seeing on the screen, you had to talk about COVID because you couldn't have a view on the economy and housing without having a view on friggin' COVID. So it's just whatever's relevant. We kind of roll that into kind of a big report and try to give people some thoughts on all that.
Now, Ben, you sent me over a couple of wonderful reports, and I've earmarked them and got posties and highlighted and all that kind of stuff. I would imagine you offer those for sale, or do you offer them on your website? Is there a way that
that's all great. Yeah. Okay. So thank you. So edgeanalytics.ca.
Yeah.
Anybody that's interested in that, and it's exclusively for real estate professionals. So whether that is realtors, mortgage brokers, developers, appraisers, even people in the insolvency industry, anybody that's kind of connected in any way to the real estate industry that would benefit from a deep dive into housing and consumer credit trends, they would be eligible to sign up. And then once you sign up, it's $30 a month. And for that, you get, call it typically 4 to 5 infographics every month, plus you get these 2 research reports. And so the way I try to think about it is, if you're a real estate professional, you're going to pay good money for good marketing infographics. So in a sense, you're getting 5 infographics, you're paying $5-6 a pop, and you get really good research. If I don't mind saying so, you get pretty good research for free, and institutional quality, and that'll help. All of that'll help position you as a kind of an expert in the field. So that's the value proposition that hopefully people will relate to.
Well, you can 100% toot your own horn here, if you will. Feel free to do that, because if you ain't going to do it, who is, right? No, and I can vouch for it, guys. I'm looking at it. I downloaded these when we said Ben just sent them over to me. There's like 57 pages of in-depth materials here, and it's some high quality good stuff. Just wanted to give credit where credit is due, my friend.
Thank you.
All right. Whew. Okay. So there's nothing really going on in the marketplace right now, is there, Ben? So
Totally
we just sit
boring.
here and we talk about the weather. We'll talk about the Leafs. We'll talk about hockey. We'll talk about our Tim Hortons that we had, and then our conversation will be done, won't it? Right?
That's right. Yeah, totally boring.
So quick question for you. I have a framework and I know your framework is probably extremely more nuanced and robust. And when I look at a market, here, my simplistic framework is I almost get out a Venn diagram, and I look at economic activity.
Sorry, man.
Oh, no worries. I look at, when you get the Venn diagram out, I look at economic activity, I look at people, and then I look at the market itself. What's going on economically, what's going on with the people. Are they moving in? Are they moving out? Are they earning more? Are they earning less? Are they working? What are they doing? And the last one is the market affordability, trends, things like that. Now, I know that's an extremely simplistic of economic activity, people, and market. What do you look at for metrics when you dive into your research into real estate markets?
Oh man, I mean, there's a lot. So I think you have to have a view from a high level around supply and demand. So you have to, every one of the Edge reports that you got does a deep dive every month into what's happening, both in terms of resale supply, what's available in the market, what's happening in terms of the flow of new listings, and then also potential new supply that's coming online, and then relating that back to what's happening with population and looking at various demographic trends. And so you have to start from that perspective, what's happening with supply and demand. But then, of course, you get into the drivers of both supply and demand. And really on the demand side, you have to have a view on what's happening with interest rates and credit availability. And so that's where things get a little more nuanced. And you've got to get a bit more of a dive into the weeds, and you've got to have a view on what's happening in the broader economy to have a sense of really what's going on with rates and with mortgage policy, which I would consider to be kind of the big 2 drivers of how on the demand side.
Okay, well, we're definitely going to dive into rates and mortgage policy as a starting point as we kind of walk down. Now, the one thing, a caveat I'm going to put in for everybody here is, I know in some cases we're going to talk national and some we're going to talk on regional, but as we all know, real estate is absolutely hyper local in many respects. You can get some direction, and you can get some trends, and you can get some information nationally that you can start drilling down, but it truly is on a local, almost house-by-house basis in some cases. And that's what makes a conversation like this really difficult, because you honestly, pardon the pun, you could pull your hair out trying to dive down into how deep do you go into the data to pull out some meaningful information.
Yeah, I think that's right. Although what I would say is, I mean, there are certainly national trends that matter a lot. I mean, interest rate policy is a national trend. And I would argue that it's probably going to be the number one, like to me, it's the number one dynamic. I mean, it's easy enough to say it's always been the order, but it really is now. I mean, it needs to be front and center, because in one sense, it's easy enough to say, oh, we've always had very low rates. We've had a persistent trend in declining rates over the last 30 years. That's absolutely true. But we're potentially into a very different economic backdrop where we may have, and it's difficult to know, but we may have more persistent inflationary pressures that might warrant a much tougher tightening cycle. Now, my base, I mean, so for example, you're already hearing a lot of very prominent economists calling for up to 7 rate hikes this year and into next year. That's a lot of rate hikes in the context of a very levered economy and housing affordability that notwithstanding places like Alberta, is extremely stretched in a lot of parts of the country. 7 rate hikes is a big deal. And now I actually don't believe we're going to see 7 rate hikes. I think we're more in line for 3 or 4 this year and next. But if I'm wrong on that, and I'm very open to the possibility I might be wrong on that too, then I don't care where you are. If you get 7 rate hikes, it's going to take steam out of housing everywhere, right?
Well, and I don't know the exact number. Maybe you can tell me on this. I would imagine the housing market, part of the economy, is an extremely large driver of what's going on with the overall Canadian economy, and it's one of the pillars that's actually driving everything. And if housing wasn't doing well, we'd be in a seriously different position right now.
Well, it's funny you mention that. That's actually one of the reasons why I'm skeptical that the Fed or that the Bank of Canada could raise 7 times, right? So you're right. Intuitively, that that's the issue, and to put some numbers to it, we actually, if you look at direct investment in residential housing. And so there's kind of 3 buckets that falls into. So you've got new construction, renovation, and then what they call ownership transfer costs. And so that is everything associated with the buying and selling of a home, realtor expenses and legals and all this stuff. Now, the long-term average, we're kind of around 5% of GDP is driven by direct housing investment. It hit a high of 10% last year. It's never been anywhere close to that. The prior cycle, so if you look at the late 70s, we had a housing cycle in Canada, late 80s, we had another housing cycle. And both of those times you hit kind of 7% as a peak. We hit a high of 10, we're currently a little over 9%. It's extremely high. And so when you look at direct housing investment, then you also look at consumer spending, right? So household consumption, and a lot of that is driven by this idea of a wealth effect. Right, that as you feel wealthier, you're much more willing to, whatever it might be, invest in big expenditures, go on vacation or buy a boat or whatever it might be. And so there's a part of that spending dynamic that's related to people's perception of their wealth. And so when you combine those two, household spending and real estate investment, residential real estate investment, it's been 85% of economic growth over the last 5 years. I mean, it's basically been the entirety of our economic growth. And so you're right, it warrants a question of how much could they raise before they tip that dynamic. Now, the one thing that I would say, and this is really important, is that households, in spite of all of the many articles that have been written warning about household debt, and I have written some of those, and I absolutely was warning about some of the dangers, and there's still vulnerabilities there, to be clear. But the funny thing is, we came out of this pandemic in much better shape financially in aggregate than we did going in. And I know that's a weird thing to say, because I don't want to minimize the reality that the pandemic was a brutal time for a lot of people financially. But when you look across the spectrum of households in Canada, what we see is debt servicing costs are as low as they've been in 15 years. Now, why is that? In part, that's because one of the weird dynamics that we saw during the pandemic is that households actually paid off high interest credit card debt. They either paid it off outright or they rolled it into their savings or into their mortgage debt, let's say. We saw household savings absolutely explode. So one of the charts that's in that chart deck that you have looks at the 2-year cumulative savings as a share of GDP. And Canadians have saved about $280 billion in aggregate since the start of the pandemic. That's equivalent to about 12% of GDP. You have to go back 40 years to find the last time we have that much savings over a 2-year period in Canada.
Right. And so that earlier comment I made about where did all that money that got printed, it went into the Canadians' balance sheets, in essence.
That's exactly right. So I guess my point would be, there's a saying that you never worry about the first rate hike, you always worry about the last rate hike, right? And I'm not at all concerned that 1 rate hike, maybe 2 rate hikes is going to tip this market significantly. But there's a point at which it becomes really problematic. And so I've done the work, and based on my analysis, if you get 6 rate hikes, which is kind of the consensus right now, and you flow that through to household income statements, by mid-2023, we're back to record high debt service ratios. And that's a problem. So in that sense, I don't think they can raise rates without tipping the economy into recession. So I actually agree with you completely.
Well, there's two things. I actually just shot a video just recently of, I said Bank of Canada swings and misses on the last announcement. They had a gimme. In my opinion, they had a 2-foot tap in for golfing analogies that everybody was expecting it. It wouldn't have upset the apple cart too much. They could have took a quarter point then. It would have signaled to the market that, we're going to do something about inflation, and it would not have impacted things too much. But they just did more saber rattling. They just did more stop, or we'll tell you to stop again, right?
You're absolutely right.
And, down the road, it may come down that they may have to do some sharper increases, maybe just, I think, this is why I wanted to have you on the call is, so inflation is at an all-time high, and whether we believe the number they're posting or not, it's an absolute high. Right? One of the tools is to raise interest rates, but there's a rock and a hard place that the Bank of Canada is at. If they go too high, too quick, they could kill the golden goose that's laying the golden eggs. So I know I talked an awful lot there, and there is a question there, but so here's the question. Your best estimation of what do you think is going to happen in the short term and medium term for interest rates?
So great question. I think I'm in complete agreement with you. I expected them to hike this month. And I'll tell you why. And I actually wrote to my clients a one-off email just saying, it looks like it's a layup that the Bank of Canada is going to hike in February, and they did not. But here's why. So there's a couple of components to inflation, or a couple of dynamics that can drive inflation, right? And so you sort of understand some of it. You get kind of this this demand pull inflation, where if they create too much money, there's too much money floating around in the system, people are buying too many goods, but there's not enough productive capacity to build those goods and services, and so consequently the prices go up. Okay, so that's one form of inflation. We're seeing that as a result of some of the monetary and fiscal stimulus that we saw. The second is what you might call like more of a cost push inflation, which is where you have, for example, supply chain issues, and we just can't create enough goods and services to meet the demand. And so there's definitely that happening too. But then within that, there's also a component of inflation that's based on psychology. And this is really important. And it's something that people don't generally give enough thought to. And so if you think about how people behave and their spending patterns might change as their expectations for inflation change, you can kind of get a sense of this. So I'll use a silly example. So let's say that you take a person who's planning on building a deck, let's say in a couple of years. Now, if they expect that the price of that deck, the goods and the services involved in building that deck are going to rise, 2% a year, they might be quite content to just leave their money in the bank and kind of slowly save until they hit that number, and then they go ahead and they build their deck. But if all of a sudden now they think that, well, maybe prices are going to go up 20% a year, maybe lumber is going to skyrocket, geez, I can't find a contractor, that the prices are going way up, maybe I should do this now. Maybe I should tap a line of credit and just get this thing built and lock in my prices. Now, if you understand that dynamic and then you multiply it across an economy, you can realize that if if their expectations of inflation start to rise, that can create the inflation, right? And so for central banks, you'll often hear them talking about inflation expectations and making sure that inflation expectations are anchored. Now, why do I highlight all this? Well, the Bank of Canada has these great surveys that they produce every quarter, and they ask exactly this question. They ask businesses and they ask consumers, where do you think inflation is going to be 2 to 3 years out, 5 years out, et cetera? And right through the pandemic, what we saw is that inflation expectations were perfectly stable, right around that kind of like 3% range. And what it was telling us is that consumers and businesses absolutely believe this narrative from the central bank that the inflation is temporary. Well, then all of a sudden, last quarter, and we just got this data 2 weeks ago, last quarter, all of a sudden, those inflation expectations did like a hockey stick. And they jumped up to 4.5%, 5%. And that's a real concern if you're a central bank, because once people start to get that inflationary mindset, it's really difficult to break it without really raising interest rates a lot. Yep. And so I expected they would raise rates. They did not. It absolutely raises the risk that they may have to raise them more aggressively going forward. So long-winded way of saying my expectations, my base case is 3 to 4 rate hikes this year. But I recognize that if I'm going to be wrong on that, it's probably that I'm estimating under right? It's very unlikely that we're standing here a year from now and there's like 0 or one rate hikes. If I'm wrong, it's probably more if there's 5 or 6 rate hikes.
Right.
And so there's an asymmetry to the potential outcomes around the base case, if you will.
Okay. Awesome.
And so I'd say, 3 rate hikes, maybe a couple more next year, but I really don't think they're going to be able to bring the overnight rate above 2%.
No, I agree in many respects. But, like I said, they had an opportunity to probably signal the right direction as opposed to just talking the talk.
They should have. I agree with you completely.
Yeah. Okay, so that's one component. So inflation, interest rates, the talk that is there's going to be, it's going up, obviously, and it's not going to go up probably as high as they're doing. They're probably overstating it to curb the enthusiasm, if you will. And most people, when it comes to inflation, you hit the nail on the head. A lot of psychology is when you're sitting there and you're now sitting and you're doing a home renovation project and you're at Home Depot and you knew a week ago what you paid for a 2x4 and now it's astronomical. Or the last time you filled up your tank of gas, man, $100 doesn't even fill your tank of gas anymore. Now everybody's starting to talk about inflation is because it's hitting the pocketbook every day of what people consume every single day, right? Okay, so inflation, interest rates. Now, what about mortgage, the mortgage market? Is there a tightening of credit? Is there a loosening of credit? Where do you think we are in that cycle? Is there some new products coming out? What do you see happening in the mortgage mortgage business, if you will?
Sure. So one of the interesting dynamics we've seen over the last 6 months is we've seen the spread between fixed rates and variable rates is really blown out. So as of right now, you're talking about 160 basis point spread between kind of your fully discounted fixed and variable, which is about as wide as it's been in 12 years. So in other words, you're being heavily incentivized to go variable because you can still get a variable for kind of, under 1.5% in a lot of cases. Fixed now starting to creep up. It's hard to get them much under 2.8, 2.9 now for a 5-year fixed. And so the result, as we've seen, is that about 55% of new mortgages over the last few months have been variable rate products, which is an interesting gambit as we move into a potential interest rate hiking cycle, because that has the potential to immediately flow through to monthly payments if it's not a fixed payment variable. So that's an interesting dynamic. On the regulatory front, I think that regulators are signaling very strongly that they are concerned with investor activity in the market. And look, you don't have to agree one way or the other, but you do have to see what they're saying, right? And you have to at least respect or at least recognize that they typically signal and they tip their hand ahead of these big potential moves. And so, what I always do is I'm always reading anything that OSFI puts out, the Bank of Canada, CMHC, and you kind of look for trends, and they all talk, obviously, as key regulators and policymakers in the housing space. And so one of the things, you can't miss it. Every one of them has been talking extensively about the role of investors and how increased investment activity might be adding some kind of speculative froth and whatever. So what's the likely policy response? Well, it seems pretty clear that if they're going to move to tighten or to take some demand out of the market, it's probably going to be focused on the second property purchases, whether that's investment or recreation. And so I would expect that by, let's say, April, so kind of the peak of the spring selling season, April, May, I would not be surprised if we saw OSFI come out and do a minor adjustment to the B20 regulations whereby they might raise the minimum down payment requirement on a secondary property. So I don't know what that's going to look like. Currently it's 20%, maybe it's 30%, maybe 35%. And they may even try to limit the share or the ability to withdraw from one property as a down payment on another. Yeah. Right? Because one of the things this government is very concerned about is wealth inequality. And the reality is that rising house prices are an issue for wealth inequality because, if you have a house already, it's very easy to buy a second one because you've got the down payment kind of baking in your home equity, right? But the person that's trying to get onto that property ladder, it just keeps moving further and further away from them. And so one of the infographics that we put out last year looked at this crazy stat from Stats Canada where in the first quarter of 2021, just in the first 3 months of 2021, the average homeowner wealth rose $75,000 and the average renter wealth only rose about $8,000. So you had this massive disparity. And if you look at this particular government, right, the deputy prime minister, Chrystia Freeland, a lot of people don't realize this, prior to running for politics, she wrote a book that is called, I don't want to butcher the title, but it's Plutocrats, The Rise of the Super Rich and the Fall of Everyone Else. And it was a book all about wealth inequality. So it's a topic of immense concern to this government. It's a topic that is of concern to policymakers. I'd be very surprised if we didn't see the move on this front sometime in, by kind of the peak spring housing season.
No, I 100% agree. And there could be a whole open Pandora's box of talking politics and geopolitical and, from politicians that never missed a paycheck over the last couple of years at all about being able to lecture us on any. Anyways, I digress. The one thing is a little concerning for me of all of this is, and you're going to start seeing it. We're already seeing it. They're starting to vilify the investor. They're starting to vilify and make people that, let's call it the everyday investor, the people that work jobs and want to provide for their family and see their retirement savings erode and they're not getting anything else. They decide to invest in a second property or a third property, do a rental property. And it is difficult. If anybody ever sits there and tells you it's easy to buy another rental property and manage a property. And I just read a story where somebody had a tenant sit in the place for 20 months without paying, right? Mm-hmm. Now they're starting to vilify the people that are wanting to create affordable housing options and rentals and second suites and secondary dwellings and garage suites and a third unit on the place and trying to rent some of this out to help with some housing. I'm sitting there going, some people might just say, you know what, just not worth it. Why bother? Why should we even do this?
Yeah, you're absolutely right. I was shocked. So I went on a CBC call one time. And do you remember there was, it was right around that time, there was a developer, I don't remember the name of them now, in Southern Ontario that wanted to raise $1 billion and go and buy a bunch of single family rentals.
Yes. Yep. And
then they wanted to add some density and turn them into multiplexes and then create some rental supply. And I, of course, immediately had all these people opposing it and saying it's going to drive rents up. And I went on and I basically just said, look, we have a shortage of good single-family rental options in Canada from long tenured options, from deep-pocketed investors. And one of the issues, I hate to say it, for somebody that has a family and wants to rent, is you're always under this the axe where at some point your landlord might sell it and you got to move. And so we should be welcoming these big pools of institutional capital that want to buy single family rentals and rent them for long term. Like I said, why shouldn't people who want to rent single family have that option? And I was absolutely attacked on air for saying that. It was hilarious that here I am the housing skeptic and I'm getting lambasted by these activists. But what I would say is there are all these anecdotes about vacant housing, and obviously, the definition of vacant in Canada is not what people think, and we'll just leave it at that. People look at the census 1.3 million vacant homes. No, that's not correct. But I would say to the extent that there are vacant dwellings, that's absolutely something that people should address, because if you're a landlord and you are creating a rental unit for a family, you're doing a social good. If you are instead someone that's just looking for a safety box to park and you're consuming scarce resources in some of the housing supply, that absolutely should be something that's addressed. And so I have concerns about that. I also have to be honest, I do have some concerns around the role of short-term rentals, and I get the economics of them. Part of the reason why the economics are so appealing is because you're effectively creating these kind of pseudo hotels, but without paying the same tax rates as an actual hotel. And so it's highly uncompetitive. And so, look, I think cities have a legitimate beef on that front as well. But for the average person that just wants to buy and provide, long tenured rental option for a household, I think it's great. We need that.
Yeah, well, that's how you keep rents down, is you create more supply of rental product and more choice for the consumer to do. If there's only 5 rental houses in your area, it's going to be a lot higher price than if there was 55 opportunity or options.
Absolutely. You and I understand that. Unfortunately, the activists that are well-meaning, but they just simply, for some reason, they can't see that.
Well, it's, and going back to just, and that's one of the beefs I have against rent controls in many respects in many jurisdictions. Most rent-controlled marketplaces, the rents are significantly higher than an unregulated rent-controlled marketplace in Canada because you're making the playing field so difficult for somebody to operate a business. Like think about this for a second. In what business do we know of that you're regulated at what you can raise and charge your prices for your product? Like it's extremely rare, but in rental housing in certain jurisdictions, you're mandated on only what you can raise your rents by.
Yeah, it's interesting. There's not often a lot of topics that get like virtual unanimous support within the economics profession, but rent controls as a detriment to new rental supply is absolutely one that virtually every economist recognizes, right? So you are right. It's well-meaning advocates for affordable housing that think that that's the solution. It's a Band-Aid. It does not solve the problem. I agree.
Well, and I'm gonna ask a couple more questions here, and then I do want to get into one of the main reasons I really wanted to have you on my podcast was I was listening to you and Tom talk about, and you mentioned, Alberta and Calgary, probably the hottest market in the country. My earbuds just popped out of my ears when I heard that about two guys from Ontario talking about Alberta again. And I do want to get there. But before we get there, I want to ask you a question about the following. And so pent-up demand, and I know the millennials is a huge demographic in Canada. And I would imagine, and I know that for a fact because I have a very similar scenario in our house here, there's a large demographic of millennials that probably just can't move out of mom and dad's home yet. Maybe they can get the down payment. Maybe even mom and dad will provide the down payment because the equity has gone up in their house so much. But they can't they can't afford the payment once they actually do own a house. Mm-hmm. Do you think that there's a large demographic of millennials still to get into the housing market here?
So it's interesting you mentioned that. If we had this conversation 2 weeks from now, we'll have a much better view of that because we're starting to get the 2020 census data, 2021 census data, I guess it was. And they roll it out in kind of chunks. And one of the ones that we're going to be getting the next couple of weeks is exactly that. It's the share of people that are living with their parents of various ages. And so we'll sort of be able to back into, in the US, and you generally demographic trends are fairly similar between Canada and the US. And the US has much more timely data on this. And they absolutely find that you got a record share of millennials living at home, for example. And so certainly that's the case in the US. I think it's a reasonable assumption that that's also happening here. And so longer term, that should support housing demand. In the near term, though, it's also very clear to me that we have pulled forward a lot of demand in the near term. And so for example, if you normalize home sales, so let's say home sales per 100,000 Canadians, I've got a chart on this. It's in the most recent Edge report. And it kind of like over the past 40 years, it kind of bumps along at a certain level, and I'm going to butcher it, but call it like 800 home sales per 100,000. And then all of a sudden, so that's per year. And then all of a sudden it jumps up to almost double that. And so we're way above the long-term norm. And so it's, in my opinion, I think what we're going to see is an extremely strong spring selling season, in part because people are going to try to front run some of these interest rate hikes. You got people that their bank account is going to raise this month. They're going to go, crap, I'm sitting on this rate hold. I better use it, or I'm afraid it's going to go up more. I better buy. You're going to get some demand pulled forward from that. And then in the back half of the year, I'd be very surprised if we didn't see sales come off a little bit. And you also have to remember that, we finished 2021 at record home sales nationally, not just by a little bit, but by 21% compared to any other year. And so, it's very difficult, like trees don't grow to the sky. It's going to be very difficult to grow off of a number like that. And so I think it's very reasonable to assume that we have pulled forward some demand. At some point, you need to contend with a bit of a demand gap, and I suspect we're going to get that in the back half of this year. So you've got sort of cyclical and structural issues at play. The cyclical issues is that we're likely to see a bit of a demand slowdown in the back half of this year. More structurally, I think you're right. I think that there are a lot of young people that want to buy, that can't buy, and that will provide sort of a fundamental underpinning to this market.
Yeah. But therein lies, and it's funny why it's so, not funny, it's just why it might be just really confusing, because sometimes it just not makes sense. Number one is you have lots of demand. Millennials want to go out. Plus you also, once you couple in the immigration numbers of people coming into Canada, they want to get out. So the demand is there. Supply's not there. But then on the other hand, the affordability is a huge umbrella over top of it too. Like if somebody can't afford $1 million home in Hamilton, they're kind of stuck. They may want to get out. There might be lots of demand, but if the supply and the price doesn't match up and the affordability, it just ain't going to move anywhere. It's like what's the old saying is the impenetrable force against the immovable object, and what's going to win, right?
Well, that's exactly right. So in one of the reports that I sent you, actually looked at this topic, and I think I sort of coined the term housing nomads, and this idea that you've got people that they want to find affordable housing or housing that fits into their budget. And it just so happens that we've hit this period where work from home has suddenly become a thing. And I don't believe that this is just a cyclical thing. I think we had a sort of a structural trend towards work from home prior to the pandemic. It was growing slowly, whatever, 0.5% a year of the workforce, or even less than that. I don't know. I'll butcher the exact number. But then all of a sudden, you effectively pulled forward 10 years worth of growth in a year. And now you've got, whatever, 10% of the work. I'm going to butcher the exact numbers. But the point is, I don't think we're going back to pre-pandemic levels of, office work, let's say. And so that opens up a whole other discussion around, okay, well, if you can work from home, if you can work remotely, and if you couple that with some of the new developments around high-speed rural internet from the SpaceXs of the world, stuff like that, it's potentially a game changer. So then the question is, well, what areas stand to benefit from that? Because, what we've seen is in places like Toronto is a massive exodus of young people out of the city. I mean, the latest data is really stunning on that. We just had, for the first time in at least 20 years, and we only have 20 years of data, so it's probably going back even further than that, but for the first time in at least 20 years, we had rural areas grow faster than urban areas. And that's because of this outflow of young people from the city looking for affordable housing. So who stands to benefit from that? Like I would say I would be long anywhere where you have young workforce, educated workforce, good job prospects, cheap startup costs, and affordable housing. And so there you're looking at that's why I'm bullish on Calgary. It's got all of those, but I also think, Atlantic Canada is seeing inflows from other provinces, primarily Ontario. And I think anywhere where you've got kind of rural or let's call it suburban, but with fairly rapid transit into the big cities, I think is going to do very well as well. So those are some of the big trends I think stand to benefit from that.
Yeah. And, and just right on a boots on the ground type of local thing. I had a conversation with a fellow a couple of weeks ago, and they were in Toronto. They worked on an online business with a large multinational company, and they could literally do their work anywhere. So what they chose to do was divest of their property in Toronto. They moved out to Edmonton. They built a house with a garage suite. They lived in the garage suite. They built that. They built the second one. They built the third one. And then by the time they're said and done, in a couple of years, they'll have about 5 or 6 houses in Edmonton, and they're living for less, and they're generating a whole bunch of rental income for it. And they didn't have a blip on their income or their work whatsoever. As a matter of fact, they had a better lifestyle that they were talking about, is living out somewhere else than living in the hubbubaloo of downtown Toronto, if you will.
Yeah, I think that's the big trend, and so that gets back to one of the reasons why I'm just bullish generally on Alberta, and maybe this is a good time to transition to that.
Perfect.
If you give me some leeway to kind of run with this,
please. I've got to get some popcorn and I got a cup of coffee because I want to hear about what's going on in Alberta here.
Well, I think sometimes you don't need to overthink things, right? I mean, here we are. You can buy real estate in Alberta today still for the same price that you could in 2007. Right? There is nowhere else in the country where the carrying costs of a single family home is lower today than it was 15 years ago, except for Alberta. And so from an affordability perspective, every other part of the every part of the country has gone up, and Alberta has gone down in terms of the carrying costs. So it's gotten dramatically more affordable. Now, if you layer on top of that, like the economic outlook, I think is great in Alberta. For one thing, I mean, it's easy to say with oil today at $93, but I've been saying this since it was in the 20s, is this idea that we're going to transition easily and quickly away from hydrocarbons is just ludicrous. We are going to be needing oil we're probably going to see demand growth for oil for at least another 10 years. We will both be using hydrocarbons extensively for the rest of our lives. And so, yes, we're going to see a move towards, electric vehicles, and yes, there's a push towards decarbonization. I'm 100% for it, but the path function matters immensely. And so we're just not going to move away from hydrocarbons. So this idea that the hydrocarbon industry, oil is dead, was always ridiculous to me. But even if that's the case, let's assume that is the case. Where else can you move and find ultra cheap office space for a startup, and ultra cheap property taxes, just general taxes, and ultra cheap housing for your employees? There's no other world-class city that has that. And so, there's a saying that the cure for low prices is low prices. And if you make things affordable enough, it'll create its own demand, and you'll see a booming industry. And so, I've got a good friend of mine who sits on an advisory board at the city of Calgary around tech startups. And he said it's absolutely booming right now. And I believe it. It can't help but boom when you've got startup costs that are that inexpensive. And so, then you take a step back and say, well, what are the concrete dynamics that we're seeing? Well, population growth is a big one. And I know you like to focus on population growth. And so what I see are sort of two things. One is, for the first time since the oil price crashed in, call it 2014, 2015, Alberta is now a net recipient of people coming to the province from other provinces. Okay, and so, for a long time there was losing people on a net basis. Some people were coming, a lot of people were leaving. And now we're back to attracting people from other provinces for the first time. The other thing that's interesting to me is if we look at, we get these great population estimates in the labor force survey every month. And it gives you a sense of how Stats Canada is thinking about population growth in various provinces. And when I look at Alberta, we're seeing their estimates of population growth at the highest that they've been since 2014 over the last 3 months. And so it's telling me that they're seeing population growth returning. And that just intuitively makes sense to me. And so you got population growth coming. The resale market is incredible in that it's like quietly put in a record year for sales. You've got inventory that's about 30% below where it was a year ago. And it's been cut by almost in half from where it was 5 years ago. And so when you look at it on like a supply demand basis, like what I call it's called months of inventory, right? The idea there is if you had 100 homes for sale and 20 of them sold in the most recent month, you would say you've got 5 months inventory. Take 5 months to sell those homes. And so that's like a key metric for measuring kind of the supply-demand balance in a market. And right now in Alberta, months of inventory are the lowest they've been since 2007. And so another way to think about it is the last time that months of inventory was this low in Alberta, prices in Calgary were rising 30% a year. And in Edmonton, they were rising 40% a year. And right now, you're less than a quarter of that. And so, you throw all this together, you look at prices in Calgary. Most people don't believe this, but for most of Calgary's history, the prices in Calgary traded a premium to the national average. And today they trade at a substantial discount, but they trade at only about 60% of the national average. My view, there it is right there. And so my view is that Calgary is going to trade back in line with the national average. And so whatever you think is going to happen to house prices nationally, if house prices go up 10% next year, I think Calgary goes up 15 or whatever. If you think prices nationally are going to fall 10%, Calgary might be flat, but it's going to make up that ground. And to me, on a relative value basis, it's just incredibly compelling. And that's where I fall on that.
Oh, hang on. Woo, it's getting hot in here, brother. Woo-wee. You're bringing the fire. And when you bring the fire, what usually gets ignited? It's dropping bombs. Okay, so yeah, you're getting me all excited here, Ben, and this is only when you geek out on this kind of stuff. So I 100% agree. And some of the research, I'm gonna just add this to you as well. If some of the population projections that I've seen about Alberta is they're forecasting in the next 20 years of adding 2.1 million more people, which is a 48% growth rate. That same number of the same time in Ontario is half that at 24%. And they're also forecasting that Alberta is going to be more populous than British Columbia in the next 20 years, that it will be the third most populous province in the country. And when you have, whether that number is right or wrong, more people are coming in. And when more people come in, you need to have more housing to supply the people. And right now there's a shortage. There's a shortage of some good serviceable land because over the last couple of years, developers haven't been bringing on serviceable land because it hasn't made sense. So they're going to have to start turning that pipe on, and we're going to have to start getting the sales. And then for some people sitting there going, this is just some on the streets information for people listening, is there's a large group of people that would have bought properties in 2006, 2007, 2008 at a quote unquote peak of the marketplace. And they're probably sitting here 15 years later, waiting to wonder when they can sell those places. And there's going to be an inventory, a shadow inventory of those properties coming onto the marketplace that you can pick up as well. So there's a large, and people say, well, the inventory is not there. I believe there's going to be more houses coming on into the marketplace in Edmonton and Calgary over the next couple of years as well, for people that just want to maybe sell a place that they bought at a last peak as well.
That's an interesting take. That may absolutely be. The one thing I do wonder about, if I were to just give one point of potential caution, is I actually think that because of how incredibly affordable Alberta is, there's a chance that over the next little while, as the resale market heats up, it actually pulls some demand away from the rental market. Because first off, when I look at rental units under construction in Alberta, they're basically at record highs, and so there is a considerable amount of potential rental supply coming. But I just think that when you look at the carrying costs of a condo relative to a 2-bedroom rental, you can almost make the argument that there's going to be some component of the rental pool that looks at a market that's starting to heat up. And they're like, well, why are we renting when we could be buying this condo for less than what we're paying and we get the upside appreciation? It wasn't really in the calculus when prices have been flat for 15 years. But when you start to see prices go back up again, it wouldn't be surprising. Again, I don't know. I could be completely wrong on that, but it wouldn't shock me just because of how affordable the resale market is. And so, in one sense, I guess investors win one way or the other. You either get, really strong rental growth, which is a possibility, or, you get decent appreciation in the purchase. So I just think,
Here's my take on that. Affordability is a double-edged sword in some respects. It cuts both ways. For the longest time, this is just Edmonton, because I have a lot of properties in Edmonton and Alberta, is when the affordability is so low that somebody can buy a property, you don't lose tenants because they're moving out. You don't lose tenants because they're leaving. You lose tenants because they're buying a home. And as the house starts ticking up, the house pricing starts going up, the rents will start going up accordingly as well. Like that's one of the reasons why in, say, Ontario, you have a strong rental market, is because if the average house price is $800,000, $900,000, they can't afford that, so then they'll rent. So I believe as the housing prices start ticking up in Alberta and there's no rent controls, the rents will start going up in lockstep together.
I think that's a reasonable base case. I don't know that it's always as clean as that. We did see, we saw, for example, even as prices of real estate in Toronto was going crazy in mid-2020, we saw the rental market decimated. Right? Rents in Toronto are now back to where they were pre-pandemic, but for a while there, you could rent a condo downtown Toronto for 20% less than you could at pre-COVID. So I think you're probably right. But, in terms of just when you think about, well, where could some of the risks be, there's maybe a risk that you see, a bit of a soft rental market, not a disaster, but maybe you see, I think vacancy rates, the latest CMHC data is kind of like, 5% range for Calgary, I believe. Maybe it just hovers in that 5-6% range, and you get inflation sort of rate or rental rate increases. Yeah,
for me, the two biggest things that I look at that I'm really concerned about, and I want to keep my tab on, is the people moving in, and the other is the job market. If the people are moving in and the people are working, it's a healthy for a rental market, especially in Alberta as well. And I 100% agree. There is a healthy supply of inventory of rental stock, especially with a lot of people building some new houses, putting rental suites in it. There's lots of choice at the same time. But if people are moving in and people are working, I think that will be absorbed pretty quickly. That's the one wild card for me as I want to watch is the employment numbers.
Yeah, and I'm quite bullish on those, both of those. I think you're going to see strong population growth, well in excess of the national average in Alberta in the next couple of years. And I think you're going to see very solid employment. And I'm just fading everybody that thinks that the oil patch is dead. We may all want an energy transition. I'd certainly want that for my kids, but the reality is the path function matters a lot, and we're just nowhere near being able to decarbonize the economy, and trying to shut down the oil patch is insanity right now. Well,
and especially when you consider there's probably going to be 2 billion more people on this planet in the next 20 years too, and there's lots of developing nations that are going to need energy. And right now, the only proven affordable, at the moment, that's proven and it's affordable is the hydrocarbons at the moment until Mr. Spock comes along and invents the dilithium crystals for us or whatever. And
right.
That's what we got. And there's if you follow a guy named Eric Nuttall, Eric is a fantastic advocate for Canadian energy, and I'm trying to get him on the show as well. But he's a fantastic, I call him a realist. He just looks at it pragmatically for Canada, and he has a wonderful thesis about we're in a generational opportunity within Canadian energy right now.
So I actually invested in his fund, and I absolutely agree. I'm a huge fan of his. I've been extremely bullish on oil and gas. Actually, it's my largest sector allocation since kind of 2020. Even before 2020, I got kind of hammered when COVID hit, but held on and it's ripped back. So I agree completely, and I just think that the negativity towards the sector's created enormous opportunities. So I'm with you on that. He's a great thinker on this stuff.
I agree. And one of the things that I tell this to people is whether the renewables are coming, and they are, I 100% agree, you need energy to develop new energy sources. Right now in Alberta, they're developing renewable energy, and they also have the energy to create and develop the new energy. So I think it's a perfect storm in many, many respects. All right, Ben, I know you've got a hockey game that you have to get to today, isn't it?
Yeah, my daughter's playing, so I'm going to try to make it over to that.
Well, I don't want to end on a real negative here, but I want to ask one question for you. So I'm going to ask two questions. One, you're going to give me a summary towards the end of what you kind of see. But before we talk about that, is what risks do you see in the market, in the housing market? And I know we can't foresee black swans, or we can't foresee another COVID or any of this kind of stuff. But what dark clouds on the horizon do you see a little bit?
Sure. So, I spend a lot of time thinking about this. It's easy to
you must be
rates.
fun at a party, aren't you?
Yeah, this is kind of what I'm paid to do, is think about where we get the risk from. But it's easy to say rates. I almost feel like that's a layup, and we kind of talked about that. There is a chance that this inflation proves to be a little more persistent than they think. There's a chance that inflationary psychology takes hold, and they've got to raise rates a lot more than 5 or 6 times to get ahead of it. There's a chance. That's a real possibility. It's not my base case, but that's out there. I'll give you one that's maybe a little more imminent and that I worry about quite a bit. So what we're seeing, this is less an issue in Alberta, although I know you guys have some bidding wars for sure there now. But I'm telling you, what I'm seeing in a lot of pockets in Ontario freaks me out. And here's why. I see homes that, in order to win the bidding war, you have to bid 10 to 15 to, in some cases, 20% above any other comparable in the area. And so when you think about what that means, when you go to close the mortgage on that property, the appraiser's got to come in, and of course you've got to push the closing out as far and the appraisal out as far as you can, and you just got to pray to God that by the time the appraiser comes 60 or 90 days later, that the market has caught up with the purchase price. And so far, that has not been an issue. Every time that somebody sets a new record in the area, inevitably 90 days later, everyone else is caught up. But at some point, you just need the market to soften All you need is for the market to stop going up 10% in 3 months, which is what it's been doing. And then all of a sudden, all these people that won these bidding wars at 10 or 15% above any other comparable, well, the appraisal comes in, and they're like, there's nothing that justifies this. Prices have been flat since you bid this. And so you're 15% under. Well, now you've got buyers that have to scramble to come up with additional capital to close, right? And so, that's something that I worry about a lot, especially if, I shouldn't say I worry about a lot, but when I think about the back half of this year, likely hitting a bit of a demand gap and maybe a little bit less demand and prices maybe start to flatten out a little, that will create an issue for people who are paying, peak prices this spring. And what we saw in parts of Toronto in 2017 is when some measures were brought in to cool the market, this exact dynamic unfolded. People who had bought thinking that they'd be able to appraise, they couldn't, or they bought one home thinking they could sell their existing home. Because that's the thing, in a hot market, you buy first and then you sell later. And that's fine as long as you can get peak price for the home that you're in, because you just paid peak price for the one that you just bid on. And so you get all these kind of non-linear dynamics, and those tend to unwind in kind of an ugly manner, and you get a lot of distress selling. And all you don't need a crash. You just need prices to go flat or go up by a couple percent instead of 10%. And that's all it takes to create some real issues. And so, I wouldn't be surprised if we saw a bit of that dynamic at play in the back half of this year. So that's something to be mindful of.
Well, I lived through that in many respects. That's what happened in 2006, 2007, 2008 in Alberta, where they were going, in 1 year there was a 74%, there was like 47, 74 to 30% year on year growth. And all of a sudden I remember the day, it was in August. And I remember seeing the newspaper article, sales finally drops or something, first time in last decade or something it was. And that was the start. And you know what happened after that? Literally nothing for 15 years. It's been flat, if not even down, that it was since 15 years ago.
Yeah, and I want to be clear, that's certainly not, my base case for what's going to happen. But when I think about the people who this spring are about to pay top dollar and potentially, 10, 15% above any other comparable in an insane bidding war, at some point, those people are going to get caught when the market just starts to slow a little bit. Not even like prices falling, but when they stop going up 3 or 4 or 5% a month. That's all it's going to take is for them to flatline. And then you better hope they've got capital to close, because, the bank's only going to lend them the 80% or whatever it is. And it's 80% of the appraised value, not 80% of the purchase price. So they're going to have to make up that difference. And that creates these potentially distressed sales and all sorts of ugly. And that can kind of snowball pretty quickly, especially once you get a few news stories that come out about these people getting burned. And then everyone else goes, oh, geez, maybe I should wait too. And the psychology flips very quickly. We saw that in 2017. Now, that's probably not going to be a massive, crash or housing cycle, but it's painful for the handful of people that bought it right at the peak. And so that's just, one of those things to be mindful of, because I do think we're close to that, right? I do think that the crazy price that we're seeing, where prices nationally, we just saw prices nationally rose almost 3% in 1 month. That's $24,000 in 1 month. That's insane. We've never seen that before. And so, at some point, when that drops to 1% a month or 0.5% a month, that's still a strong market. But for the people who are expecting 3% growth, that's a real problem when they go to close. And that's all it takes to cause some issues.
Well, it's like the analogy I use is, if you're driving along on a freeway on the connector there, and you're going at 140 kilometers an hour, and then all of a sudden you go even to 100 kilometers an hour, it feels like you're stopped. Or maybe you go through a construction zone and you have to go down to 60. You're still moving, but it feels like you're crawling. Now,
I love that analogy. That's actually an analogy I've used before too. You're absolutely right. That's exactly the right way to think about it. Still a strong market, but it's going to feel much slower. Yeah, I agree with that.
But don't get misunderstand me, guys. I think there's actually some things going to bolster the market from having a catastrophic drop, and that is the supply-demand offset that we've talked about. Is there's a strong demand, there's no supply, so that'll keep things strong. The other there is the immigration and the people coming in is just going to even exacerbate. There's a dollar word for you, is going to make it even worse. So I don't foresee any giant collapses, but I also don't foresee any giant torrid pace that has been going on for the last couple years as well.
No, I think that's the right way to think about it. Just if you're in a crazy bidding war in places like Ontario and you're thinking about paying 15% above any comparable to beat everybody else in a bidding war, like just recognize that there's a risk the appraisal doesn't come in, and then what are you going to do? Right?
Yep.
That's
how are you going to close on it? Right.
Right. That's it. And so that's not like a structural housing crash type issue, but for a handful of buyers, it's going to be pretty shitty.
Yeah.
So
it'll be painful.
Yeah.
Your jubilation just goes to pain very quickly here. So
yeah.
Okay. So here's what I'm going to end off with. I'm going to end off with the following. So let's say this is just like we're on a news story, and you had like less than 3 minutes to tell. If someone came and asked you, Ben, what's your best 3-minute synopsis of what's going on in the housing market, how would you summarize everything what you're going down and kind of just encapsulate it all into a tight soundbite for us?
Yep, sure. Surprisingly strong population growth, especially 2018, 2019, hit almost 600,000 year-over-year population growth, which we've never seen before. And against that backdrop, we had single-family completions that have dropped dramatically from where they were in decades prior. And so steep decline in new single-family housing construction, steep increase in population growth. Then all of a sudden along comes a pandemic where all of a sudden the thing that's in most demand is lower density living. And so you turbocharge demand, and you turbocharge demand via low interest rates, and you end up with this confluence of factors that leads to this insane market. And that's where we are today. I think we're probably at peak insanity, which is not to say we're at the peak of the market. But I do think that, last month we had 28% year-over-year price growth. I think that's probably pretty close as good as we're ever going to see it on the national scale. So maybe next month it's 26, and 6 months from now it's 10 or 15% year-over-year. But we're going to start seeing a slower rate of growth going forward. And I think in the back half of this year, the combination of slightly higher interest rates and maybe a bit less froth in the market means that we see a bit less demand, which hopefully all else equal will let the market balance itself out maybe a little. But it's very difficult at this point to be extremely bearish unless we get 6 or 8 rate hikes, and then it's a very different story. But 3 or 4, I think this market's okay.
Wow. Woo-wee! It's getting hot in here, brother. And of course, dropping those bombs. So, Ben, you are a pro. You are a pro at what you do. You eat, breathe, and sleep this. You're extremely well articulate. No wonder your business and your company are doing very well, because you represent, you're a very good advocate on both sides. You're a very good analyst of what's going on in the market. And I just wanted to just acknowledge that you're doing a hell of a job. So
thank you, Russell. Appreciate it. It's been a pleasure catching up. Finally, nice to put a face to the name.
Yeah, I was looking forward to this, and you over-delivered 10x, by the way, my friend. So
I appreciate that. Thank you, sir.
All right, Ben, thanks for all your time. And guys, pay attention. More episodes like this are going to be coming out. Have yourself a wonderful day. So what did you think about today's episode? Didn't we go into a lot of in-depth information, in-depth insight? And Ben is just such a wonderful resource for the real estate investing community. And as I mentioned in the episode, I just about fell off my chair when a couple market researchers out of Ontario were calling for the Alberta marketplace to be the hottest place to invest your capital at the moment. Alberta and Edmonton are open for business, and there are tremendous amount of investment opportunities if you know what you're doing. I see a lot of people making some big mistakes just jumping into the market. So if you'd like not to make those mistakes and have a stress-free experience investing into the Alberta marketplace, I'd highly encourage you to book a consultation right now. There will be a link in the description below if you'd like to have one of these one-on-one consultation sessions. All right, everybody, have yourself a wonderful day. Bye for now. Hey, I sure hope you enjoyed this video. If you are interested in moving forward with velocity, if you're interested in being a successful real estate investor, only 2 simple next steps from here. Number 1, below where you're watching this, there will be an opportunity for you to subscribe. And over here will be a hand-selected video for you to keep moving forward. Continue your journey forward. Just click on over here for that hand-selected video for you, and we'll see you on the other side. Thank you very much.